You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everyone. The stock market's struggling. Rates are heading back up again, which means bonds are struggling. And inflation has appeared on the radar, which is adding further downside to stocks, but has been a good thing for commodities. So I'm going to try and run through the entire market if I can here today. When I say the entire market, I don't mean every single investment, obviously, on the market, but I'm going to try and hit almost every asset class except for maybe currencies, foreign currencies. But before I do that, as always, a few housekeeping items. If this is your first time listening or watching, then thank you for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koos and on Instagram at Financial Surgeon. Last but not least, all links, visuals, charts, and other educational resources are always available on our website at libertaswealth.com in the Education tab, which is where I'll be putting the slides as soon as we finish up the recording and post-production for the podcast here today. So for any of you that are listening on iTunes, if you want to come back later, check out the web and look for those slides, or if you just want to head to YouTube and watch everything in real time, either works just fine. So let's go ahead and jump into it. First and foremost, quote of the day, as always. This one comes from Paul Samuelson, an economist and professor, and what he said was the stock market has forecast or predicted 9 of the last 5 recessions. So if you follow that math, again, I'll say it again, the quote is the stock market has forecast 9 of the last 5 recessions. Now, this is a while ago, so it's I think it's 14 of the last 7 or something like that at this point, or 14 of the last 8. But the point of this is that not every bear market or correction or market crash has to necessarily be accompanied by a recession. So there are bear markets or market crashes that occur, which Ned Davis Research considers that to be a drop of 20% or more in the stock market. Obviously, if there's a drop of 19.9%, they don't consider it a crash. But if it's 20% exactly, then it's considered a crash. So I guess that's all debatable. But at the end of the day, there have been many crashes in the market and stocks that have had nothing to do with the economy. So let's get into some charts here. The first thing I want to talk about is something that I shared last week. I think I shared this through an article as well, but it was in the podcast. And this is my friend Andrew Thrasher. He has something called the volatility risk trigger, the VRT, and it triggered 3 weeks ago at this point, I think, or maybe it was 2 weeks ago. Yeah, 2 weeks ago. And the volatility risk trigger is a proprietary piece of research that has a very, very good win rate at predicting an uptick in volatility when triggered, say, over the next 2 to 3 weeks. So whenever this triggers, it is expected with a pretty high probability rate that within the next 1 to 3 weeks that we would see an uptick in volatility. And this, like I said, triggered 2 weeks ago, and that's exactly what we've seen. We've seen a huge uptick in volatility right along with a big drop in stocks. We were already seeing some deterioration at the NASDAQ small cap level. Tech stocks were already deteriorating. So we were already seeing some trouble beneath the surface, but now the S&P 500 is joining the party, or at least leaving the party, maybe is the better way of saying it. So I think that was a good indicator to show a couple weeks ago, and how probabilities, not certainties, but probabilities can tell us that maybe we ought to be a little bit cautious going forward, which is exactly what we did. The next thing I want to talk about is, this is a very, very long-term chart. This is a 1 month. Every bar on the chart is 1 month, so this is going all the way back to 1993. This is the S&P 500. Again, every bar is 1 month. So one of my concerns that I have, and I've put red arrows here, for those of you listening on iTunes, my concern is the space between the 10-month moving average and where price is today. And if you look back in time, if we go all the way back to 1993, before the World Trade Center and dot-com bubble, before the mortgage crisis, if we go back all the way back in time, to 1993, there's only been a handful of times where we've seen the stock market this high above its 10-month moving average. And the space between the 10-month moving average or the 10-month trend and price is what I call daylight. I can't remember the original analyst who coined that phrase, but it makes a lot of sense. When you start to see a lot of space get created, in other words, when the market goes up very fast, you get a lot of space between the 10-month trend and the current price. And the more space that's created, the higher the probability that we could expect either a correction in the market, a market correction, or a correction sideways through choppiness and digestion. And what we're seeing right now is an exceptional amount of daylight between the 10-month moving average and where the market is today, which means that I think that going right along with that volatility risk trigger we were talking about a second ago, I think that it's pretty we could be pretty confident in saying that it wouldn't be out of the ordinary to see the market start to chop sideways or even correct down in price, which is what it started doing this past week. The next thing I want to show you is a little shorter term chart. This is the S&P 500, and what we're looking at is momentum has been diverging on the S&P 500 since mid-April, which means we were seeing lower highs in momentum with higher highs in the market. Now, right now, the market just literally closed just barely above its 50-day moving average today. Today's Thursday. I'm recording this at 4:21 p.m. is the timestamp as I look over at my clock here. So what we're seeing here is this divergence that's taken place. And the question we have to ask ourselves now is, are we going to see the S&P 500 head lower from here before it bottoms out, finds that bottom and heads higher? I do continue to believe that as long as we have the Fed on our side, as long as rates are at zero, as long as we're seeing stimulus, billions of dollars of bonds being purchased, BBB rated and higher bonds, literally on a weekly basis, as long as we see continued accommodative action on the part of the Fed, I think it would be very difficult to see a market crash. Not impossible, but difficult. So the question then becomes, as this knife falls, so as the market goes down, and we don't want to try and catch the falling knife, where does it start to bottom? Where does it start to settle? Where does volatility start to decrease so that we can let that knife settle, pick it up off the ground, and safely move off to, say, new highs if that's what's going to happen from here? What I see right now, however, is again, negative divergence in momentum on the S&P, and we're starting to see that confirmation of that negative momentum divergence in price as the market has gone down this last few days. The next thing I want to show you is a very short-term chart. This is something I could tell on Twitter today that I'm not the only one looking at this. I look at this chart a few times a day, even though it's unnecessary to update and refresh this chart many more times than once or twice. But I look at this chart and several charts several times a day. But this is a 60-minute chart of the S&P 500, and you can see going back to April 12th, we'll call it, there was a kind of a sideways consolidation that took place. For those of you on iTunes, basically just the market went sideways through April 12th, and then it headed higher. It pulled back and kind of bounced off this line in the sand below our feet. It bounced again, went down, bounced off that same line, headed up, bounced again, headed upward, broke out to all-time highs, but then failed and headed back to that line again, bounced up, pulled back, bounced up, and broke out to new all-time highs a second time, ended up being what's called a bull trap. In other words, where the market breaks out and then heads right back down again. Or it can also be considered a throwback. And now not only have we seen it throw back and a false breakout to new all-time highs, but we've also seen the market break below this line in the sand, this level of potential support below our feet has now become an official level of support, which is now potential resistance above our heads. So we've broken below that floor of support. The market tried to get back above that level, that ceiling of potential resistance, and it kind of settled back in right in the middle of the day's range. So this is something that I'm going to be watching very closely on a day-by-day basis to determine how much risk we should be taking in our portfolios and how much cash or gunpowder we should have on hand. Because as long as we're below this line, this dotted line below our feet here, or now above our heads, and we're seeing lower lows and lower highs, that is by definition a downtrend, and at least on a 60-minute chart, that is. So a short-term downtrend. When we look at a chart of the Qs, so this is the Invesco QQQ Trust ETF, 100 stocks in the NASDAQ. What we're looking at here is that the NASDAQ has already fallen below its 50-day moving average and is already what I call below water. It's already underwater. We don't like to see our investments, whether that be an individual stock, it could be a bond ETF, it could be a stock ETF like this one. We don't want to see them spending too much time below water, because what happens is our portfolio or the investment in question can suffocate, metaphorically speaking. If we go back in time, we can see back in August of last year, August and September, that as the market headed up before the market correction that took place in September, we could see that it became overbought on a momentum basis. That's good. Granted, when things are overbought, it might suggest that it's possible to see a short-term pullback. Short-term pullbacks are healthy, but we saw this momentum head above 70 into bullish territory, which is good. But since then, while the market has headed higher, and when I say the market, I'm looking at, again, this is the NASDAQ 100, we have not seen momentum have the ability to crack back above that bullish 70 level. In fact, we've had 2 new highs, one in February and again another in April, and you could even say that in May we slightly matched that high on the NASDAQ 100, and we still couldn't see a higher high in momentum or a crack above 70. So I would call that, slightly negative evidence. When we look at small cap stocks, this is the IWM, this is the Russell 2000 small cap index. So these are small companies. You can see back in February and March, and those of you listening on iTunes, in February and March we had this decline, again this lower high in momentum, just like we looked at on the S&P. And this lower high in momentum accompanied higher highs in price. So we saw basically the Russell 2000 going up, small cap stocks going up, but lower highs in momentum, which is what's called a negative divergence, which can, again, it's not a certainty that stocks will go lower when there's a negative divergence, or in this case, the Russell 2000 will go lower, but it is a clue, it's a hint, it's evidence, and in this case, it's not positive evidence, it's negative evidence. So now what we've seen here is not a correction in price necessarily speaking, but the Russell 2000 it's basically exactly in the same place as it was at the end of December. It just hasn't gone anywhere if you just draw a line from end of December into where we are right now. But these horizontal lines, these lines below our feet that I would be looking at right now would be the March lows, and then we could even say the lows from April as well, which were a little bit higher. That would be the first line in the sand that we don't want to break through if we want to see this market rebound. And then the next line in the sand would be the January-February lows. That will be the next line in the sand. If we head lower than that, we're spending a lot of time underwater. And again, we're going to have to wait for that knife to settle, hit the ground, so we can pick it up safely and put some risk management in place and make sure we're not taking too much risk on any investment we'd be buying. Speaking of investments we'd be buying, or we could be buying, this is a relative rotation graph here, so an RRG. This is Julius DeCamponeer's research. Amazing charts, a lot of fun, and very visual, which for those of you who are visual learners, this is a really, really easy way to understand relative strength as opposed to numbers and percentage changes and rates of change on a chart. So the 0 point of the XY axis right here is the S&P 500. And then the upper left quadrant is the improving quadrant. Upper right is beating the market. Lower right is weakening versus the market. And lower left is lagging. So it goes improving, leading, weakening, lagging. And generally speaking, not all the time, but a majority of the time, a statistically significant majority of the time, we see ETFs, stocks, tend to rotate in a clockwise fashion as they go through their cycles of relative strength, from improving versus the market, leading the market, weakening, and lagging. And what I want to pay attention to here is a few things. First of all, notice how a lot of the arrows, a lot of the ETFs in this case, are heading out of the weakening quadrant into the lagging quadrant. What that's telling us is that a lot of investments, and I would argue the majority on this chart here, which is almost every industry group that you could buy on the market, by the way, That's what I've put on this RRG. Almost every investment industry group you could buy on the market is heading in a southwesterly direction, which indicates that a lot of these investments are weakening versus the overall market, so on a relative basis. When we drill down and we start looking at some of the investments that are improving, we can look and see that there's junior miners, so gold miners, small cap miners, as well as large cap miners, the GDX. We can see that there's low volatility. Consumer staples are some things that are doing well. Construction and home builders, maybe some real estate in here. Industrials, steel's looking good. Materials are kind of back and forth, almost like chopping back and forth between the weakening and leading quadrant. But when I sum this up, what I see is a lot of defensive names, defensive investments that are leading or improving, with a lot of offensive names that are either declining in strength, weakening, or heading and settling into the lagging quadrant. And just to name a few here, this is solar stocks, this is genomics, this is technology, these are IPO stocks, social media stocks, online retail, lithium battery stocks, hack is cybersecurity, momentum stocks and PDP, IBB is biotechnology, Moses, this is cannabis, so marijuana stocks, Block, this is blockchain heading southwest, XOP, even oil. Now I still think that oil is a good investment in my opinion, but what this is telling us is it's starting to give us evidence that we're weakening now, and if this heads, XOP is oil exploration, if it continues to head southwest, then we're probably not going to own this thing. We're not going to want to own energy anymore, let's just put it. So, all right, so that's probably enough about the RRG. The only other thing I'll show you here, I purposely highlighted this chart. Cathie Wood is a very, I would call, relatively famous portfolio manager who's gotten a lot of glory this past year, and she's getting beat up a lot on the interwebs between Twitter and social media because her portfolios, many of them which did incredibly well in 2020, have done incredibly poorly this year. You can see just looking at this chart, it doesn't take a technical analyst to see that this is not good. A lot of these things like the ARK funds is what they're called, so genomics, technology, and so on, are down right now off the January highs. They're down anywhere between 30 and 40%. So obviously not good. Let's change gears and get off the stock market. Let's talk a little bit about commodities. Gold. So this is a little bit more positive evidence. Gold is starting to look good. It's been underwater, kind of in a downtrend for a while. We see two lows here. So between March and April, basically the gold went down. It hit a low right around $157 per share on the GLD. It bounced. It hit 157 again, while at the same time we saw a higher low in momentum, which would be your positive divergence. So as opposed to negative divergences, which we were talking about earlier, this is a positive divergence. This is good evidence. We not only see that positive divergence, but then we see gold break out, come back out from underneath water here, the 50-day moving average. It breaks out above the 50-day moving average. It pulls back, and now it's headed higher again. What I'd like to see, it pull back a little bit more here, or at least consolidate sideways, let the 50-day moving average catch up. And then I think that we could see, as long as it does that, as long as it doesn't head down and head back underwater again, I think gold could end up being a relatively viable investment. And if you want to know why, when I'm looking at these things, I'm not looking at the news or for information on whether or not we should buy or sell an investment. I'm more interested in knowing, say, if the U.S. dollar were to go down, then when the dollar goes down, gold has a tendency to go up. Inflation is another thing that's a concern right now with commodities in general. Inflation goes up, commodities have a tendency to do well. Speaking of commodities, moving on from gold, let's talk a little bit about gold miners. I mentioned them on the RRG chart the other day. You could see, again, actually here, I said the other day, I meant like a few minutes ago. So on the RRG chart, again, we see gold miners and junior miners heading out of the lagging quadrant, pointing northeast in the improving quadrant, heading toward the leading quadrant. That's what we want to see if we're looking at any investment that we might want to buy. If we look at the individual chart, what we see is that gold miners never got below 30 on the momentum, on RSI. So momentum never got below 30. That's bullish, that's positive. And not only that, but we see higher lows in momentum, higher lows in price, and then again, just like gold, a breakout above the 50-day moving average, a nice pullback, and now we have a rising 50-day moving average with gold miners kind of pulling back right along with stocks. And so this, I think, starts to look like a very viable investment, which we own, full disclosure, in our strategic models currently. Switching from gold miners and gold to oil. Obviously, if you haven't seen the news, I shouldn't say obviously, if you haven't seen the news, a lot of gas stations in the southeast, the Carolinas, Florida, 70+% of these gas stations are literally out of gasoline due to the pipeline hack that occurred earlier this week, or last week. I think it was Friday, actually. But anyway, so I'm watching oil here, which has had a nice run off the lows in October, and now it kind of peaked out in March, pulled back, got this nice tight sideways consolidation that took place between March and April, and now it's kind of just chopping sideways, creepy crawling like a caterpillar up, kind of following its 50-day moving average. But I think this could be another viable investment right along with the rest of the commodity environment. And you can notice if you're watching on YouTube, iTunes, those of you listening, the momentum, so RSI, again, momentum, we want to see in a perfect environment, a very bullish environment. When momentum goes down, we not only want to see it stay above 30, but an even more bullish environment or realm would be if it stays above 40, and that's exactly what's happened here, is that oil has pulled back in momentum, but it's held above that 40 level, which is really good and very positive. Changing gears again, let's talk about bonds for a second. I put this in a couple podcasts as well as an article to our clients where I was taking a bond trade. And the reason I was taking this bond trade was because we saw lower lows in the price of bonds. This is the 20-year U.S. Treasury. After it had gone down 24%. U.S. Treasury bonds down 24% since August. So after it had gone down 24%, we see these lower lows in price and we see higher lows in momentum. Again, we're back to that positive momentum divergence. And I took a trade here. In other words, we bought bonds in our clients' portfolios right here in this area early in April. We broke out above the 50-day moving average. It pulled back. We got a higher low, headed back above water here. That was good. But then all of a sudden, as rates started going up, remember, interest rates and bond prices are inversely correlated. So when interest rates go up, bond prices go down. And what we saw this week happen was interest rates went up pretty quickly, so they reversed, and as interest rates went up, the bond prices went down, and I had my line in the sand below this low right here, so we sold the bond positions that we owned earlier this week and walked away. And if this thing can head back higher again, we could buy them again. And then actually, I purposely circled the momentum indicator here because while bonds have currently headed down, and it looks like we might have a low here. We'll see what happens tomorrow and then early next week. But if we can bottom out on momentum above 30 and head higher again, that would again be bullish for bonds in this case. But a lot of that kind of ties on what's going to happen with rates. So speaking of rates, let's talk about that for a second. You can imagine if you look at the bond charts, if you just look at interest rates, you should see the opposite, or at least you should notice they're pretty much inverse. This is the 10-year Treasury yield or 10-year Treasury note. So this is interest rates, not bonds. And you can see again, as bonds went down on the 20-year, that is down 24%, the 10-year Treasury has gone up since pretty much August. It peaked out in March, headed down. That's why bonds started going up. And now what we've seen is the interest rates spent a little bit of time below water here, below the 50-day moving average, and then started to head up again between yesterday. This week, the interest rates have gone up almost every day. And we can see here at the bottom of the chart that momentum, for those of you listening on iTunes, momentum has bottomed twice now, above 40, which if you remember from earlier today, I was saying that whenever momentum bottoms above 30, that's bullish, but especially if it bottoms above 40, that's an even more positive indication that perhaps the investment in question and what we're looking at here is 10-year rates could be in a bullish regime and could head higher. So right now, my money's kind of on interest rates hitting higher from here, although we are kind of in no man's land in the middle, but we'll have to see what happens. And then last but not least, this is my pre-flight checklist, as I call it. Stole the name from my friend Dave Keller. Thank you for letting me name my pre-flight checklist what it is. But this is something that I look at on almost a day-to-day basis. And the reason I use it is to determine what the short-term trend is, which you can see looking up here in the upper left-hand corner. Right now, the short-term trend is pretty much down on almost all levels. The intermediate term trend is kind of mixed, but mostly bullish. So the intermediate term trend is still relatively healthy, and the long-term trend is still pretty healthy. Now the NASDAQ, a little bit different. So the NASDAQ 100 is looking a lot more negative than the S&P 500, which is not a good thing because as I mentioned last week on the podcast, whenever we see a divergence where the small cap stocks on, say, the small cap index like the Russell 2000, which is the chart I'm looking at here, whenever you see small cap stocks going down and the NASDAQ going down, but the S&P's not, one of two things has to happen. Either A, the S&P is going to reach down, grab the hand of the NASDAQ and small cap stocks and pull them up, or the NASDAQ and Russell are going to reach up, grab the leg of the S&P 500 and pull them down with it. So what looks like is happening right now is that the latter. It looks like the small cap stocks, the NASDAQ, are actually pulling down the S&P 500 and the Dow, the large cap stocks. So we'll have to see what happens over the course of the next day, next week, and so on as tax season ends on Monday. Monday is the tax filing deadline. There is a possibility that people have had to sell stocks to pay their taxes, and when that happens, obviously, if you have more selling enthusiasm, more selling pressure than buying pressure, then prices must fall. So if we had a lot of people selling stocks this week to pay their taxes, then that could be a reason why things are going down. Obviously, there's been some inflation worries, there have been some interest rate worries this week, but we're just going to kind of have to see what happens over the next few days. But right now, one of the things that I watch again on a daily basis here is, and I labeled this, is it safe for new entries? And you can see it's mostly red. There's 3 blue boxes and all the rest are red. So right now, I'm not feeling pretty good about adding new investments to portfolios. I'm kind of more in a state of caution, patience, waiting for things to get better. And like I mentioned, as the market goes down, think of it like a falling knife. You don't want to try and catch a falling knife. You might get your hand cut up. So it's better to kind of wait, let that knife hit the ground, let it settle, and then see what happens from there once it's safe to pick it up again. All right, so that's it for today's show. Feel free to share this episode with your friends and family, and if you'd like to discuss your personal situation further, remember that you never have to be a client to ask a question. If you'd like to set up an intro call or Zoom meeting with myself or someone on my team, just head over to our website at libertaswealth.com, click on the contact page, and you can schedule something in our calendar. You actually have access to our calendar on that page, or you can send us a message through our website, and we can coordinate something with you. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get not only these updates for podcasts, but also our other screencasts, videos, articles, Coach's Corner educational material delivered directly to your inbox every time we publish something. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. As mentioned earlier, I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.